What's up everybody, Gen X Dividend Investor here. In this valuable video, I answer the question of should you only invest when something is cheap. I'll also share some common mistakes people make when it comes to dividends, healthcare, and some other important financial concepts you need to understand, so I strongly encourage you to stay until the end. But first I wanted to do a shout out to Scott Goodwin, who just clicked that join button to become my latest channel member. I recently started offering the ability to join my channel membership, which grants a variety of perks, like getting to vote on which thumbnails I use, along with being able to watch and comment on my videos before I release them publicly. Plus they get badges by their comments, which level up as long as they remain a member, eventually to this cool looking King's Crown badge. Plus their YouTube logo is randomly shown to everyone that clicks on my homepage when using a desktop browser. Thanks folks. Okay, let's get into it. So Warren Buffett is pretty much universally recognized as one of the best investors of all time, and as of this moment he is number 6 on the list of wealthiest people in the world with a net worth of about $138 billion. What helped shape Buffett's value investing strategy was his mentor, Ben Graham, aka the father of investing, who averaged a 20% annualized return from 1936 to 1956, as compared to the market which returned about 12% annualized, so Ben outperformed by over 50% a year for over a decade, which is astronomically good. Graham wrote one of the most well-known investing books out there, aka The Intelligent Investor, which I'll include a link to in the description of this video, and as an Amazon affiliate I earned from qualifying purchases. His book talks about the importance of distinguishing the price of a stock from the value of its underlying business. And Graham was known to value dividends, which probably irks the people who poo-poo dividends. Specifically, I'm talking about the people who promote the dividend irrelevance argument, which basically says that a company's dividend payments don't add value to a company's stock price, and so they also tend to say that there's no reason to believe that dividends, or the growth of dividends, are an indication of a good stock to own. And some of them say that dividends are not relevant in determining which stocks may have good future returns. Some also say that dividends don't offer any added benefit to investors. But if that was true, then why would Ben Graham have said, the true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operation results of his companies? Clearly Ben found value in dividend returns. Ben also said, the real money in investment will have to be made, as most of it has been in the past, not only out of buying and selling, but of owning and holding securities, receiving interest in dividends and increases in value. And he also said, one of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. He continues on saying, we think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. So not only does Ben Graham equate more quality companies as ones that have paid continuous dividend payments for 20 plus years, but he suggests that some investors may be justified in only buying companies that have paid and increased their dividend for 20 plus years. That sounds counter to the people who favor the dividend irrelevance theorem, who say that dividends are not relevant in determining which stocks may have good future returns. Ben also said that an investor is satisfied with increased dividends in a rising market. Clearly, Graham is a proponent of good dividend companies, and he obviously disagrees with any notion that dividends don't offer any added benefit to investors. In fact, he literally said that the true measure of common stock values, of course, is not found by reference to price movements alone, but by price in relation to earnings, dividends, future prospects, and to a small extent, asset values. You'll find dividend naysayers saying that those that seek out dividend stocks can create more demand for those stocks, but those are just examples of biases taking over. Now, I do agree that people shouldn't blindly invest in a company just because it has a dividend, and I'm concerned when people focus too much on yield over quality, but something like 80% of the S&P 500 pays dividends, and dividend stocks have historically outperformed non-dividend stocks, on average, over long periods of time in markets around the world. However, that doesn't mean that a company paying a dividend is the reason why they outperformed, but instead it's because large established companies that are profitable and valuable and that tend to invest conservatively are all characteristics that often enable long-term outperformance. And I don't think you should ignore quality non-dividend stocks just because they don't have a dividend, unless you're in retirement and you don't want to deal with selling shares like me. So I agree that using dividends as your only measure to select stocks doesn't make sense, but I also feel that focusing on quality dividend stocks can be a great long-term investing strategy, though I also feel that most people will probably do better going with an index over individual stocks. Finally, I think that dividend naysayers underestimate the value of truly passive and growing income that comes from quality dividend stocks. Anyway, clearly Graham favors and value dividends, but what about Buffett? Well, if you're itching to leave me a comment about how you think Buffett doesn't like dividends, then I'd recommend you first watch my video called Why Berkshire Hathaway Will Eventually Pay Dividends to see evidence of why Buffett feels dividends should be paid by certain types of companies, and why he knows that someday even Berkshire will pay one. And speaking of Buffett and Graham, there's a famous quote that people often attribute to them which goes, in the short run the market is a voting machine, but in the long run it's a weighing machine. That metaphor means that in the short term, a stock's price is just a measure of how popular it is, i.e. the market sentiment for it, which manifests as votes for it by the bulls who are buying and holding, or votes against it by the bears or sellers. And unfortunately, some people are overly influenced by current news or market conditions instead of business fundamentals. Like you hear that GameStop is shooting up because lots of people are buying it, so you run out and hit buy, not because it has great fundamentals with improving revenue and earnings and cash flow and such, but instead because it's popular at the moment. Thus, in the short term, you'll find that the stock market reflects lots of irrational attitudes and expectations. However, in the long run, the market is a weighing machine in the sense that companies' financial performance are more accurately reflected in stock prices. So I like to think of intrinsic value of a company as a magnet, or as gravity which is influencing stock prices to go towards it, though short-term pressures can push it away from where it makes sense. I created this diagram many years ago, which sums up how stock prices migrate towards earnings and cash flow and ultimately intrinsic value. The purplish blue line is the intrinsic value, and you can see how the black stock price line kind of oscillates around it, and over time quality companies tend to trend up. The black stock price line can fluctuate wildly based on short-term news and headlines. The ideal time to buy a stock is often when it's underpriced, which is represented as areas of red where the stock price fluctuates under its intrinsic value price. However, if your belief in the future growth of a company is large enough, then buying even when overpriced may make sense. Plus, if your strategy is to buy and hold for generations, then buying at any stock price can work out, and it's just that your returns may be less than if you buy when something is on sale, and it can take materially longer to get a good return if you just invest whenever. Similarly, the best time to sell is when it's materially overpriced, which is any period on this graph along the areas of green, because those are all the times when the stock is higher than its intrinsic value. This example chart could represent decades of stock prices, so you need to understand that something could be underpriced for years or overpriced for years, but stocks eventually tend to drive towards their real intrinsic values, which you can probably calculate with discounted cash flow calculations and often by analyzing price to earning trends. A low PE ratio doesn't automatically mean a stock is undervalued, and a high PE ratio doesn't necessarily mean a company is overvalued. But a 15 PE is often a reasonable valuation for most, but not all companies. So as earnings go up, then stock prices tend to go up, broadly speaking. A conclusion you should draw from this picture is that the difference between a stock's current price and its estimated intrinsic value becomes your investing opportunity, assuming you believe the intrinsic value is a good estimation. And those who do invest like this are known as value investors, since they're transacting based on some form of fundamental business analysis, which attempts to calculate a stock's intrinsic or book value. Book value and intrinsic value are two ways to measure the value of a company, and there are a number of differences between them, but basically book value is a measure of now, and intrinsic value leverages forecasted estimates of the future. Now, one of my favorite tools for assessing the valuation of stocks is FASTgraphs, which I'm an affiliate of, and which utilizes aspects of Ben Graham's valuation formulas, so let's take a look at some tickers in it to see what I mean. Here we have a ticker I'm long in, Procter & Gamble, from 2004 until now, including some forecasted future years. The black line is stock prices, and the blue line represents a calculated PE multiple, which you can think of as how the market has valued the company over time, which for PG is around a 20, thus it's generally had a premium valuation relative to the historic median PE in the SP 500, which is around 15. Whenever the black price line is above the blue PE trend line, that tends to mean it's expensive relative to its historic norms, and when it's under it, then it's cheaper than its historic norms. On the right-hand side, we can see that the annualized earnings growth over the selected time frame is 5.81%, and you can and should change the time frames using slider bars underneath the graphs in order to see how growth has been trending more recently, but for now we'll just look over the last 2 decades. Even an expensive stock might still be worth investing in if its future growth is compelling enough, or a cheap stock might not be worth investing in if its growth is too low for you. If you believe a company will have super strong growth going forward, then you may still even buy when it's not on sale. Waiting for it to get cheap may help you with greater returns, but not always. A cool thing you can do is select 2 points on the graph to see returns in the time frame you select. So like the starting red point I picked on the graph is when the black price line was above the blue PE trend line, meaning its valuation is a tad expensive. At that time, PG was trading for $74 a share at a 22.25 PE, which means a $10,000 investment could have purchased 134.68 shares of it. And if you'd held it until now, at a 25 PE, then your stock would have appreciated 116%, which is about 4.86% annualized without dividends, or 174% with dividends, which is a 6.4% annualized return, and your 10K would have turned into a 21.6K. But if you had waited a bit and invested when it was cheaper, i.e. under the blue line, then we see the returns end up being bigger, at 7.63% annualized versus the 6.4% from before. Of course, if its growth is good, then things will trend up, so waiting may put you in a situation where you remain on the sidelines for a long time, which is why patience is important with investing. Sometimes waiting works out, and sometimes it doesn't. And you'll find that some stocks can remain overpriced or underpriced for over a decade, but stock prices will eventually trend towards earnings. Now let's take a look at IBM as another example. You can see how stock prices trended up with earnings, and then around 2013-2014, as earnings and projections of earnings started decreasing, stock prices also started trending down. Then around 2021, we start seeing earnings trend up again, and stock price turned around to the point that it looks quite overpriced right now. These quick visual graphs are part of why I value FASTgraphs enough to pay for a subscription to it, and I don't plan to ever be without this tool as long as its pricing remains reasonable and I'm still investing, as the insights are just too helpful to not have it. That doesn't mean you need to, I'm just saying that's what I like to use and what I recommend to friends and relatives now who also invest. I used to calculate discounted cash flows manually, and I did a variety of other valuation calculations on my own, and I even built automated tools I used in part of my valuation process, but now I prefer FASTgraphs. With all that being said, be careful if you find yourself fixating too much on stock price alone without understanding business metrics and trends. Stock prices in isolation aren't going to tell you enough. You want to know how earnings have been trending and for how long and how they've changed and such. You want to know about debt levels and blah blah blah. Another takeaway you should have from all this is that earnings growth often drives dividend growth as well, which is the white line on the chart. If you see earnings falling and that keeps happening, it'll probably only be a matter of time until the divvy becomes problematic, which could mean dividend cuts, suspensions, taking on debt to pay it off until earnings look better again, stuff like that. That's why investing in quality companies is so important, and why growth is so important, because all of that often leads to stock price appreciation and the opportunity for continued dividend growth. Business fundamentals will enable or limit your dividends. They will push your stock price up or down over the long run. Of course, over the short term, anything can happen, which is why even companies with great fundamentals can crash when the market crashes. But long term, the market is a weighing machine, and business fundamentals should win out. Oh, and don't take FASTgraphs or any tool as gospel. Instead, think of things as probabilities and trends and stuff like that. Plus, remember that us long-term investors should not be overly concerned about short-term volatility in stock prices. Investors don't care about that, but stock traders do, and I doubt that any traders are watching my videos. So try to capitalize on buying when things are cheap, assuming you also believe in the future growth story. And if you buy when something is overpriced, then you should really think strong growth is in the cards, and thus selling when overpriced is ideal. And it may make sense to sell something even if it's underpriced, depending on what you think will happen with earnings in the future, combined with what your overall needs are. If you believe the business is dying, then selling for a loss also probably makes sense. If you believe in the business but its stock keeps falling, then that's when your conviction and research will be tested, and your ability to have diamond hands. You could be wrong, or it could just be another period of extreme fear. The hardest buys are often going into something when most others are running, and it can be tough to let go of something if you've held it for a long time, even if it's turned out to be a dog. Just make sure to focus on data and logic to guide your decision making. Let's take a look at a company that has been floundering a bit in Walgreens Boots Alliance. We see earnings trend up, with stock prices roughly trending the same, until things started going south around 2015 for the stock price and 2018 for earnings. Sometimes you'll find stock prices react sooner than earnings, since stock prices often reflect what people think the business is going. But over long terms, you'll find stock prices and earnings often dance together. So a question for WBA is if its go-forward growth will trend up, like this shows, which is utilizing forecasts from various analysts. If so, then getting in now might end up being great, as it looks pretty underpriced. But if earnings drop or are stagnating, or if debt is growing too much, then the stock won't look too pretty. Some people are okay taking the risk of moving into a position if they see it's been beaten down but they believe the future will be brighter, and other people just avoid it until the company starts proving their earnings. And so to specifically answer the question I posed in the title, my answer is no. I personally don't only buy dividend stocks when they're on sale, but I do tend to prefer doing that unless something is so compelling and dynamic that I believe its future growth potential merits the increased risk I take from buying things at a premium price. Please leave me a comment telling me if you've ever bought anything that you thought was expensive, but you were glad you bought it anyways. And leave me a comment telling me if you've ever sold something when it's cheap, but that still ended up being a good decision for you. Okay, now I want to change gears and share my thoughts about some comments I read on a thread about someone who had retired on dividends, as these comments highlight some common mistakes people make. This first comment was from someone named Catherine, who said she had retired early 3 years ago, and that most of her assets were in dividend stocks. But when she was signing up for healthcare on the exchanges, she skipped over the questions about if she wanted any subsidies to lower her healthcare costs, because she thought that even though her income was low, her net worth was high from her stocks, so she assumed she wouldn't be eligible. She did say she's happier now being retired than she'd ever been during her 27 years of working, which is exactly how I feel as well. Anyway, the mistake she made was thinking that her eligibility for health insurance subsidies was based on assets, but it's actually based on income. Like when I first retired and dividends were paying the bills, my wife and I's income was low enough that our healthcare was literally free. Basically, instead of it costing like $1,000 a month for our family health insurance, it was subsidized down to about $0 a month because our income was low. But then I started taking dividends out of our retirement accounts as well, which drove up our income, and then we started owning more for insurance. Thus, the TLDR is that as of right now, if you get medical or dental insurance on the public exchanges, then the amount you pay is based on what your income is, And the lower your income, the lower your costs will be, all the way down to being free. They have online calculators you can use to estimate your costs based on different plans in your personal situation, or you can just call up their customer support staff on the 1-800 number. Before the healthcare exchanges, I had looked into getting health insurance when I wasn't working, but found out that they wouldn't cover any pre-existing conditions I had, which kind of made it useless. But once the laws were changed such that health insurance companies can't refuse to cover you or charge you more just because you have a pre-existing condition, then that gave me the opportunity to be able to leave 9-to-5 jobs knowing that I could still buy good insurance. And as someone who's contributed into the system for almost 3 decades, i.e. payroll taxes and blah blah blah, and basically never got anything in return, it was nice to finally get something back from the government in the form of a healthcare subsidy, at least for a period of time until our income grew larger again. And healthcare can be a tough one to cover. I mean, the inflation-adjusted price of medical care has increased by over 114% since 2000, outpacing the 81% rise in overall prices. In fact, literally today I went to buy some thyroid medication for my wife on Amazon's online pharmacy, and I saw they had tripled the prices. Fortunately, I checked Mark Cuban's pharmacy, and their prices were a lot cheaper. I read that 60% of healthcare costs come after the age of 65, and if you're over 85, you can use 3 times more healthcare services than people between 65 and 75. So keep investing in solid stocks so that your future self will have enough retirement income to pay for whatever you might need. And then moving on, another comment I saw was from Joe, who asked how someone could live off their 401k at age 42 since they thought you had to be 59 before you could take withdrawals. Then someone named Scott wrote that you can withdraw as early as 55 if you meet certain guidelines. But the reality is that you can withdraw from your IRA at pretty much any time, and there's no need to show a hardship to take a distribution. However, your distribution will be included in your taxable income, and it may be subject to a 10% additional tax if you're under age 59.5. There are other nuances based on the type of IRA you have and where you live and such, but I'm under age 59.5 and have been taking out early distributions of my cash dividends for over a year now, and yes, I pay taxes on that income, but it also has allowed us to raise our standard of living. Personally, I'm pretty frugal and would be fine living on less, but my wife likes to splurge a bit more, and we still reinvest a portion of the retirement divvies. Okay, and the final comment worth sharing is from someone who said that if you had a $1.2 million dividend portfolio, you'd be making $50 to $60K a year in divvies. Then he continued on saying if the stock market crashed, then that $1.2 million portfolio could be worth $800K, and that drop would keep you up at night. Now, part of the beauty of quality dividend stocks is even when markets crash, they've historically kept paying out more, even through bad years or decades. So while your portfolio value drop might irk you, your dividend income probably keeps improving, assuming you're holding quality tickers. No, dividends aren't guaranteed, but as long as your companies are selling their products, then they'll probably continue paying you, the owner, a share of their profits in the form of a dividend. This guy also mentioned that he thought medical insurance would cost $10,000 a year, but in my experience, if your family only makes $50K a year, then your health insurance is effectively free. Like, here's a health insurance marketplace calculator I found on a website. Let's put in that a family makes $50K a year of income, has 4 people in the house, and that no medical insurance coverage is available from you or your spouse's job, which is what it was for me. And we'll say that the household has 2 non-tobacco using adults and 2 kids, all of which was my situation. This estimates that an average silver health plan on the exchanges, which is what I got, would leave you with a total monthly cost of health insurance of only $28 a month for the entire family. However, it would be $1,289 per month if there weren't any subsidies because your income was a lot higher. And if your $50K of income came from qualified dividends in a taxable account and you didn't have any other income, then you'd owe $0 in federal income taxes, which is pretty sweet. Anyway, I brought up those 3 comments because they're all examples of common financial mistakes people can make, and hopefully it helps clarify things if you're wondering about health insurance when retiring early. And with that, I'd like to close things out and do a shout out to Divi Dripper for Life, who just snagged a Patreon Aristocrat seat. I'd like to pitch everyone to consider using my FASTgraphs affiliate link along with my coupon code in the description of this video, because doing that allows new users to get 25% off their first payment, even if you sign up for a full year all at once. Also consider using my Seeking Alpha affiliate link, which often comes with benefits for new user signups. And take a look at joining as a channel member, or check out my Patreon to see if it has any seats you want to join up for. Whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Plus, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 81 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.